What's up, guys? I'm Jeff Montgomery and welcome to Tax Planning on the Whiteboard. If you like what you hear, make sure you hit that subscribe button. Taxes are an important topic, and when it comes to retirement, we look at taxes as an expense, just like groceries and utilities, housing, healthcare. After all, the more you pay in taxes, the less income you'll have to spend. And just how most things increase over time due to inflation, your taxes could also increase over time. And that's our topic today on Tax Planning on the Whiteboard. Just a quick disclaimer, not specific information to anyone watching the video. Your circumstance is completely unique. So I want you to use this as general information and education only. Don't implement any strategies you hear today without first consulting your financial or tax professional. Okay, now that we got that out of the way, let's go to the whiteboard. When it comes to retirement, there are three possibilities for your taxes. Your taxes could be lower in retirement than they are today, and that is the premise of tax-deferred savings vehicles like 401ks and IRAs. You defer your taxes to the future in hopes that your tax rates will be lower during your non-working years. Your taxes could be the same in retirement as they are today. That's a possibility. Or your taxes could be higher in retirement than they are today. This is a risk that many savers are beginning to understand. With our federal debt and congressional spending, tax rates in the future could be higher than they are today. So let's go over 5 potential ways your taxes could be higher in retirement than what you could possibly do about that. Number 1, your tax brackets could change. How can that happen? Or I should say you could change tax brackets. Your filing status could change. There are 5 different ways to file taxes today as a filing status. We have married filing jointly. We have married filing separately. We have single, we have household, and we have qualifying widower. Your federal tax bracket determines what percentage of your income you will owe in taxes. For example, when one spouse passes away, that year of death is the last time that you can file maritally filing jointly, typically. Consider some tax planning strategies like income acceleration into that final tax year while you can still file married filing jointly. If you decide to downsize and sell your primary residence after the death of a spouse, remember you have 2 years to maintain that capital gain exemption for a primary residence if you haven't remarried. So if that was part of your plans, keep an eye on that very important date. Number 2, your tax brackets could change, and this is legislative risk. Even if your filing status does not change, Congress could decide to change the tax brackets. Now, we saw this in the Tax Cut and Jobs Act of 2017, where the brackets were actually lowered and expanded at the same time. Well, guess what? That legislation in 2017 that took effect in 2018 is set to expire in 2025 and revert back to where taxes were in 2017 before that act was passed. So that's effectively going to raise your tax rates, your tax brackets. Consider some tax planning strategies like Roth conversions while the tax brackets are still at these lower levels. It's possible to also accelerate income into those tax years before they are set to rise again. Number 3, deductions could be eliminated, they could be capped, or they could be lowered. This also falls under legislative risk. Look, if deductions are lowered or capped or eliminated, that means that there's higher taxable income that are subject to tax. So the tax rates may not have changed, but you end up paying more tax because some deductions were eliminated. Now, some possible strategies. If you're over 70 and a half and you're charitably inclined and fall within the standard deduction ranges and you cannot itemize, you may consider a QCD from your retirement accounts. And if you're over the age of 72 and are required to take a minimum distribution from your IRA, a QCD may meet all or a portion of your required minimum distribution. The maximum amount of a QCD per year is $100,000. So again, pay attention to those limits. Number 4, Congress could just say, hey, we're going to change the way assets are taxed or income is taxed. And the best example I can give you for this is Social Security was not taxed prior to 1984. But in 1984, Social Security became taxable up to 50%. And then in 1993, that amount was raised to 85%, depending on a calculation called provisional income, sometimes called combined income. Specifically with Social Security in this example, the idea would be to lower that provisional income calculation. So we have to understand what is provisional income in the first place. Well, provisional income is 1/2 of your Social Security plus your income from IRAs or from earnings, even from municipal bond interest, pensions. So how do you lower this number? Again, if we look into Roth conversions, where in retirement, distributions from Roth IRAs are tax-free if they are a qualified distribution, they are not included in this calculation, therefore lowering that provisional income number. And number 5, brand new taxes could be created. For example, one tax provision last year in Biden's Build Back Better plan on the House side had a cap in retirement accounts. Now we know this did not pass, but other things could pass. In other words, in this particular proposal, that would have required savers to withdraw 50% of the excess above the cap each year. Never underestimate the creativity of the Washington bureaucrats when it comes to creating new taxes and coming after your income. So what's the overall message here? Create tax diversification in your retirement plan by utilizing a complete approach, by creating some potential tax-free strategies along with your taxable retirement accounts and brokerage accounts. You may feel much better protected if tax rates increase in the future. Again, always seek out professional help with your specific circumstances. And if you like these videos, do me a favor, hit that subscribe button. It's that easy. Again, I'm Jeff Montgomery, and we'll see you next time on Tax Planning on the Whiteboard.